Let's talk about one of the game plans that we have talked about for many years, which is the concept of refi till you die. Okay, doesn't this sound cool? Okay, so I'm going to give you two examples of how this could work. And they're just examples, and they're simplified because of something called the rule of 72s. Okay, you've heard of the rule of 72s, right? And that just means that things double. Okay, and we'll see how they double at different rates. So in this example, let's talk about, for just round numbers' sake, a property portfolio where you've purchased, let's just say it's 10 properties in diverse markets, and say the properties were $100,000 each, and this is in your workbook somewhere. David will find it first, I'm sure, and tell you all. So you've got 10 $100,000 properties. To buy them, 20% down is $200,000, and then you've got closing costs, and I'm just rounding this off. It could be different. Hey, Drew, how you doing? That's about $35,000, and then you've got reserves. Remember, I did say 4%. Here's the first time that number is actually on a slide. 4% of $1 million is $40,000. So $275,000 total. And one of the questions that people ask about this stuff is they say, hey, Jason, how am I going to get rich with $300 a month per property in positive cash flow? Well, that doesn't sound like you're going to be rich. If you multiply that times 10, you've only got $3,000 a month. But the real way you build wealth, a lot of it happens behind the scenes because income property, remember, it's a multi-dimensional asset class. And so in this refi till you die example, I'm going to show you the money, as Jerry Maguire would say.
Show me the money!
And here's how it works. You started with this $1 million portfolio, 10 properties, diverse markets. A lot of people ask, well, how diversified do I want to be? One of the mistakes that I made is that I over-diversified. You know that intro for the Creating Wealth Show, 17 cities and 11 states? That was a mistake. I'm going to take that intro off because it's actually not true anymore because I've been selling some properties to reposition and consolidate my portfolio. I would recommend that you don't diversify into more than 5 markets. Reason is, it's just simpler to deal with fewer parties, fewer cities, fewer tax collectors, fewer insurance agents, fewer property managers. So you might own 100 properties, and that's 20 in each of 5 markets. 3 to 5 markets will give you a good enough diversification. You do not need to be like me, which was a mistake. It really became a hassle being overly diversified. So diversify, but don't over-diversify. Maybe you've got 2 properties each in 5 markets or 3 1/3 properties in 3 markets. And so the way it looks is like this. You've got your $235,000 initial investment. You've got loans for $800,000 or 80% of the value. And your equity is $200,000. This is how it looks when you start. Now, what happens as you move on? When 12 years go by, at that 6% appreciation rate, your portfolio is going to double by the rule of 72. It's going to double. It's going to be worth $2 million now. So now you've gone from $1 million to $2 million in 12 years. And I know you're all thinking, 12 years is a long time. Not really. I'm having my 10-year high school reunion coming up. Just kidding. Now what's happened in 12 years? Think about this. Say you're 40. 40 is the new 25. Really is. That is actually true if you take care of yourself. So now your property is doubled. You're 52 and you've got $1 million gain already. And you stopped. You just did the 10 and you quit. And then you just let it ride. $1 million gain. You go to the bank and you say, hey, I've got equity in here. Jason told me I don't want equity. So I want to pull my equity out. I want to engage in something I call equity stripping. You have the properties, you own the assets, but you strip the equity out of them. So basically what happens here, you still own the asset, but you got all the money out. And so you still control it and you've got an asset, which is awesome. So then the bank says, okay, your $2 million portfolio, 80% of that, we will loan you that. So we're going to give you loans totaling $1.6 million. And now your equity has doubled to $400,000, difference between $2 million and $1.6 million in financing, so $400,000 in equity, and you've got $800,000 in cash that you can now stuff under your mattress. You can go to Las Vegas and gamble it away. You can, do whatever. For the next 12 years, if you just take this $800,000 and divide it by 12, and you don't invest it, you stick it under your mattress, it earns 0 return, you have $67,000 a year, almost $67,000 a year, tax tax-free. Why? Because there's no tax on borrowed money. This $67,000, I'm rounding a little bit, $67,000 tax-free is equivalent to, well, it depends on your tax bracket, but let's say it's equivalent to about 100,000 is fair. That's about $100,000 taxable equivalent. Of course, during the 12 years, maybe inflation has happened, probably because your property portfolio doubled in value. These are nominal numbers. They're not real numbers. So granted, $2 million, you can say 12 years later, ain't what it used to be. 67,000 ain't what it used to be either, but it's still money. It's still something. So let's go to the next cycle. Let's go another 12 years. Now remember, you're only 52 and you're now living on this tax-free money every year. Another 12 years, now you're 64 years young in my example. And 64 is the new 40. Just wait till you start listening to my longevity show. I've been interviewing people. I know I've been a little slow to launch that show, but it's pretty incredible what's happening in longevity sciences. Now your property portfolio has doubled again. It's worth $4 million based on the rule of 72s at 6% appreciation. And you've got a $3 million gain from your original $1 million investment. And you go to the bank and say, hey, refinance me 80% loan to value. Okay, we'll give you $3.2 million in loans. Your equity has now doubled again to $800,000. And you've got $1.6 million in cash. Now, granted, hopefully what you really did the first time is you took that $800,000 and invested it, and you earned a return on it. But we're not even counting that. We're not even counting the tax benefits. We're not counting the positive cash flow. We're just talking about very simplified math here. It's just properties double every 12 years. End of discussion. Now you've got $1.6 million, and for the next 12 years, just divide it. Don't invest it. Don't earn anything on it. Stick it under your mattress. You have $133,000 a year to spend tax-free. That's probably equivalent to about, nearly $200,000 a year in taxable. So you're 64. Now, let's go 12 more years. And now how old are we? We're 76 years young. 76 is the new 55. And now our portfolio is worth $7 million. We refi, we get $6.4 million in loans. We have $1.6 million in equity. Our equity has quadrupled. Or no, more than that. It's gone up 8 times. What's that, quintuple? What do you call that? Anyway, it's a lot. So now we've got $1.6 million in equity. We've got an asset worth $8 million, a $7 million gain. And we've got $3.2 million cash out tax-free. Divide by 12, we got $250,000 a year tax-free to live off until we're 88. And 88 will be the new 68. Your loan balances are going up. I don't know what the interest rate will be. Nobody does. I don't know what the refi rules will be. They might say, we'll only give you 50% loan to value. They might say, we'll give you 135% loan to value. They actually do those things sometimes. We've certainly been through those cycles. The question is, if my debt keeps going up, then my payments probably keep going up. Absolutely right. We know historically that rents adjust for inflation. So the rents go up to keep pace with housing prices and general inflation. We don't know this will happen for sure. We do know for sure it's happened historically. There's something I call the 3 dimensions of real estate. I'll talk about that in a bit, because what you see is that there are all these correlating and non-correlating indicators dependent upon the interest rates, the ability to qualify for loans, the housing prices, the housing affordability index. We'll get into that. Okay, so let me just go over another quickie example for you, okay? And remember, we didn't count that all that time, if you bought the right properties, you had positive cash flow, you had tax benefits, you had some other benefits too. This is just simple stuff. We didn't talk about inflation-induced debt destruction or any of that, which we'll get into. So let's say you want to do this faster, and you've got the 7-year itch, as they say, right? And so here, we'll just take a portfolio that's twice the size to get there faster. It's $2 million initially, and your investment to acquire that portfolio is $470,000. I'm just doubling the numbers here, that's all. And your loans are 1.6, your equity is $400,000. The next round, only 7 years later, in this example, you're only 47, not 52. You've got a portfolio that's gone up by 50%. because it goes up 50% in 7 years, or doubles 100% in 12 years. You've got a $1 million gain, 80% refi, $2.4 million in loans. I'm going to go a little faster because you already saw the idea in the last one. $600,000 in equity, $800,000 in proceeds that equal $114,000 a year for 7 years, tax-free, no tax on borrowed money, because you're only dividing this one by 7, remember? We're on a 7-year cycle here. Now it goes to $4.5 million. You've got a $2.5 million gain, 80% refi, $3.6 million in loans, $900,000 in equity, $1.2 million cash out, tax-free. Live on that for the next 7 years. You're now 54. You're only 54 years old in the 40 example. So $171,000 in tax-free income. Boom, boom, boom. Over $250,000 in tax-free income in 21 years. Now, there are a lot of assumptions we're making here, obviously, because, as Yogi Berra said, the future ain't what it used to be. We don't know the future. Nobody knows the future except Janet Yellen. Or Obama, because he's God. Okay, so anyway, or at least he thinks he is. So in this example, the rents adjust for inflation. The property prices adjust for inflation. We don't know if 7 years or 12 years is the right time to refi. Like maybe the climate won't be good at that time. It's just a concept is all it is. You might refi in 5 years or 15 years. But the point is to not kill the golden goose. The golden goose that lays the golden eggs are the properties. You don't want to sell them. Selling is not the point, except for me. I know I broke my own rule occasionally with that apartment building because, I don't know, a bunch of one-bedroom units just didn't, to me, seem like they were going to go to an incredible price. I just wanted to move. I'm moving money around, okay? But I'm in the game, for sure. So, yes?
So what happens after you die? I mean, you just tell your kids to keep doing this, the exact same thing with your wife?
Absolutely, yeah.
What about the tax?
And your mistress. You might tell your mistress that. Depends who you leave your money to. What? No tax. Under current law, as Randy said when he was up here, it steps up to current market value. So your heirs, under the law could change, for sure. But under current law, it steps up to market value. So whatever the market value is at the time you pass on, you've left this to your heirs. Yes?
Does depreciation start over every time you refinance?
No. Depreciation has nothing to do with financing. It has to do with the IRS. So the depreciation schedule is 27 and a half years. So you know how I said that, I want you to buy and hold your properties? Actually, I take that back. I want you to buy and hold them for 27.5 years. And then you buy new ones and start depreciating those again. Okay, so, yeah.
Are there lots of companies right now that'll cash out refinance after 4 properties?
Oh, yeah. Yeah, you can get cash out refis. I mean, you got to have good credit and the properties have to be rented and performing and things like that. But you can get cash out refis, sure. And I mean, the loan rules may change. Like I said, it could be a different loan to value. There's a million things we don't know.